Hey everyone, welcome back to the channel. Today, we're diving deep into one of the most talked about ETF battles of 2025, REX ULTY versus YieldMax ULTY. Both of these funds promise high income through advanced options strategies, but the big question is, which one is actually winning the income race? We'll break down their strategies and structures, dividend yields and payout schedules, portfolio composition, performance and risk metrics, and ultimately, which ETF might deserve a spot in your income portfolio. Grab your coffee, this is going to be a detailed and data-packed discussion. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Let's start with the big picture. Over the last few years, investors have been chasing consistent income in a volatile market. Traditional bonds and dividend stocks haven't been enough for many retirees or income-focused traders. That's where option income ETFs exploded onto the scene. We've seen YieldMax, REX Shares, Roundhill, and others introduce products targeting weekly or monthly income streams through covered call and synthetic option structures. Both ULTY and ULTY fall into this new generation of enhanced yield ETFs. ULTY, YieldMax Ultra Option Income Strategy ETF, built to generate ultra-high income through synthetic exposure and call writing on high volatility names. ULTY, REX IncomeMax Option Strategy ETF, a newer competitor offering a similar promise but with a different engine under the hood. Let's dig into how these ETFs work. YieldMax ULTY uses a synthetic covered call strategy. It holds short-term US Treasury collateral and buys long call options while simultaneously selling call options on large-cap equities, often focused on the S&P 500 or tech-heavy exposures. The goal: generate high option premium income while maintaining a degree of participation in market upside. On the other hand, REX ULTY, part of the IncomeMax lineup, uses a slightly different approach. It leverages options on ETFs and indexes with a built-in risk management overlay. REX's focus is on risk-adjusted yield, aiming to avoid the extreme drawdowns that some ultra-yield products suffer from. Key difference: ULTY chases maximum yield through higher volatility exposure. ULTY aims for smoother returns and potentially less volatility drag. Now, let's talk about the part everyone wants to know, the yield numbers. As of the most recent data, ULTY's annualized yield has hovered between 40–55%, depending on market volatility. REX ULTY will be delivering around 30–40% annualized. That's a massive difference on paper, but remember, yield is not the whole story. Higher yield often means higher risk and potential capital erosion. Let's analyze the consistency of those distributions. ULTY's distributions have been weekly, offering frequent cash flow, attractive for income investors. ULTY, meanwhile, will pay weekly depending on its internal mechanics, but with a steadier payout ratio. When comparing ETFs like these, total return is what really matters, yield plus price movement. ULTY's price chart has shown more volatility, largely because its income engine depends on short-term call option premiums. ULTY's NAV has been more stable, reflecting its balanced approach to risk and return. If you had invested $10,000 in each ETF since launch, ULTY might have preserved capital slightly better. ULTY might have paid out more income, but with higher price decay. It's a trade-off between high yield with more risk versus moderate yield with more resilience. Let's not sugarcoat it, both ETFs carry risk. For ULTY, high yield means exposure to short-term volatility, option decay, and potential NAV drawdowns. Income can mask losses if you're not reinvesting properly. For ULTY, more conservative, but not risk-free. It still depends heavily on option pricing and volatility regimes. Both are not ideal for short-term speculation. They're income engines designed for investors who understand derivatives exposure. The key question is, can they sustain their payouts if markets calm down and volatility falls? History shows that covered call ETFs often struggle in flat markets, something both YieldMax and Rex are aware of. Another factor, cost. ULTY's expense ratio, around 0.99%. ULTY's expense ratio, slightly lower, 0.85%. Not a huge difference, but in the long run, those basis points matter, especially when combined with trading spreads. Liquidity check. ULTY, backed by YieldMax's popularity, trades with higher daily volume and tighter spreads. ULTY, being newer, is growing but still catching up. For active investors, that liquidity can make a big difference in execution quality. So, who are these ETFs actually for? ULTY, perfect for aggressive income seekers who want weekly cash flow and don't mind short-term NAV swings. Think of retirees supplementing pensions or traders parking idle capital for yield. ULTY, better suited for cautious investors who still want high yield, but with a smoother ride, perhaps those diversifying away from equities or bonds. If you want to build a balanced income portfolio, you could even hold both, splitting exposure between ultra yield and steady yield. So, who's the winner? If we're talking pure yield, the crown goes to YieldMax ULTY. It pays more often, and currently leads in visibility and volume. But if the race is about sustainable income and total return stability, Rex ULTY might be taking the smarter, longer-term route. Ultimately, the answer depends on your risk appetite. Want maximum income? Now go with ULTY. Want consistent yield with less volatility? Lean toward ULTY. The real winner. Investors who understand both and position themselves accordingly. If you found this breakdown useful, hit that like button, share this video with a fellow investor, and subscribe for more deep dives into the world of income ETFs. Tell me in the comments, which one do you think wins the income race, ULTY or ULTY? Thanks for watching, and I'll see you in the next one.